In this video, we will look at 3 dividend stocks from Dividend Aristocrats ETF. Interest rates are rising, we have high inflation, and these 3 dividend stocks may do fairly well in the current environment. It is a bad idea to time the market, but if the market goes even lower, it is very likely that we will still get our dividend. These 3 stocks have high dividend yield, they have low payout ratio, so the dividend seems to be stable, and they are also from Dividend Aristocrats ETF. So these dividend stocks are often called bond proxies. They have managed to increase their dividend for 25 years, 25 consecutive years, and we will also look at their current valuation. So let's get started. First of all, if you want to get ideas about the dividend stocks or other investing ideas, you can subscribe by pressing the subscribe button under the video. You will not miss a single new video. Okay, right now we will look at these 3 dividend stocks. They are from Dividend Aristocrats ETF, ticker NOBL. All stocks from this ETF are the members of the S&P 500, and they have also managed to increase their dividend for 25 consecutive years. So they are often called bond proxies. They have high dividend yield and predictable earnings. So these stocks may do fairly well in the event if the market goes even lower. We are building a tool that will help us to analyze stocks. We will use this tool to analyze these 3 stocks. Okay, the first stock is 3M, ticker MMM. It's from the industrials sector. It has a 74.5 billion market cap. We can see that it is trading at the lowest price for the last year. If we look at the 5-year chart, we can see that its price is almost the same as it was during the COVID pandemic. If we read about the company, we can see that it's a diversified technology company. Main segments are safety and industrial, transportation and electronics, healthcare and consumer. So it's a diversified company. If we look at some of the ratios, we can see that it has 3.3 billion in cash, 17.6 billion in debt. So they have 14.2 billion in net debt. So it is less than 3 times earnings, so debt not seems to be an issue. If you look at their dividend, they have 4.5% dividend yield. They have payout ratio of less than 61%. So I like to see a payout ratio of less than 60%. In this case, the dividend seems to be stable. They have return on equity of 37%. Return on invested capital of 17%. So according to these numbers, they definitely have a moat. If we look at their profit margins, we can see that they have gross margins of around 47%, operating margins at 22%. Okay, so 3M has high dividend yield, low payout ratio, and it is trading almost at the same level as it was during the COVID pandemic. If we look at their current valuation, we will use next 12-month free cash flow yield as a valuation metric. Terry Smith is using this similar technique. We can see that the average free cash flow yield for the last 3 years is 5.77%, and the current is 7.5%. So according to this metric, 3M seems to be undervalued. The free cash flow yield is almost at the same level as it was during the COVID pandemic. Okay, the next company that we will look at is Procter Gamble. Okay, we type in the ticker PG. We can see that it's from the consumer defensive sector. Its market cap is 320 billion. It is trading almost at the lowest price for the last year. If we look at some of the ratios, we can see that it has 8.5 billion in cash, 33.7 billion in debt, so they have 25 billion of net debt. If we compare that to the earnings, we can see that it is lower than 3 times earnings, so debt seems not to be an issue. They have high dividend yield of 2.6% and a low payout ratio of less than 60%. We can see that analysts are projecting for the growth rate to be around 4% in the next year. They have also high gross margins, high and stable gross margins of around 50%. and operating margins at around 23%, and they are rising, which is a good sign. We have looked at Procter Gamble. If we look at their current valuation, we can see that the mean, the average, was 4.17%, while the current is 5.2%. So according to these metrics, the stock seems to be undervalued. Again, the free cash flow yield is almost the same as it was during the COVID pandemic. Okay, and the last stock that we will look at is Target. Okay, we punch in the ticker TGT. We can see that it's from the consumer defensive sector. It has 66 billion market cap. It is trading at the lowest price for the last year. If we look at some of the ratios, we can see that it has 1.1 billion in cash, 17.3 billion in debt, so they have 16.2 billion of net debt. It is almost the same as 3 times earnings, so that seems to be manageable. They have 2.5 dividend yield, and they have low payout ratio of 28%. They also have high return on equity of 54% and return on invested capital of 21%. They have gross margins of around 29% and operating margins of around 7-8%. Okay, we have looked at Target. They have high dividend yield, low payout ratio, the lowest from the group. If we look at their valuation, we can see that the mean or average free cash flow yield, we're using next 12-month free cash flow divided by market cap. So the average free cash flow yield is 4.75, while the last was around 8%. So the free cash flow yield is even higher than it was during the COVID pandemic. So according to this metric, the stock seemed to be undervalued compared to its own history. Okay, we have looked at 3 dividend stocks. They have high and stable dividend. They have managed to increase it during the last 25 years. They are members of the Dividend Aristocrats ETF, so they are often called the bond proxies. So not only these 3 stocks may do fairly well during the crisis, they have also high and stable dividend. Also, there is another stock which I believe has a much higher upside potential. Here is the video about Warner Brothers Discovery. A very interesting situation there. If you are not subscribed to the channel, you can do this by pressing the subscribe button right here. You will not miss a single new video. Thank you very much for watching till the end, and see you in the next video.